5 months apart, almost 5 months in 4 days. All right, so we're going to round it down to 5 months in between each wave cycle. And again, I could do the same thing and start on July 11th and measure to December 5th, and it's still going to be very close to 5 months. So it doesn't matter. All these lines are now equidistant and exact time intervals between one another. So now that we set that chart up there with these cycle lines, you can count really one by one. You can see, okay, here, all the way to the left, the market went down on that day or after that day. The next cycle line, well, yeah, on that day, 5 months later, it hit a high and then the market dropped. Here was basically a nothing. It just stayed for a while and even went up a little bit. But here it went down. Here it went down. Here it just continued up. Here it went down. Here it went down just a little bit. So if we're measuring these cycles, you can see that the large majority of the time, this market, the diamonds, follows a 5-month, more or less a 5-month pattern. So if this last line here is December 9th, we could say that end of April, beginning of May, we're going to see another major downturn in the market. So between now, which is now coming on to February pretty soon, for the next 2 months or so, we really should be on guard and be very, very protective of our accounts so that we don't catch ourselves off guard and start taking aggressive long positions when there looks like there's going to be a market correction coming. All right. Now, let's get rid of this chart, and I want to put another market up there. Let's look at the let's look at the S&P. I'm going to put SPY in there. And look at that. Oh, buyer beware. You're going to get caught in the newsletter there somewhere. Okay, get rid of that. Yeah, John Murphy, by the way, created the site, and I have the utmost respect for John. He was on CNBC for a while as their leading technical analyst, and he's really a very well-respected authority in this area. He is just one of those guys that's always educating, and he has a passion for that. Now, with the spiders, I'm going to switch to a daily chart because the cycle finder can also work very well on daily, weekly, monthly, whatever you want. So if you're an investor and not so much a trader, you would look at another chart and maybe use a monthly chart or go further out in time. By the way, Stock Charts is not the only one that has cycle lines on there. Actually, the Thinkorswim platform has it as well, but unfortunately I'm having a technical issue with that. A lot of the folks have the cycle finders nowadays. Okay, so again, to repeat, I go to annotate. It brings up another chart. My pointer turns to a crosshair. And now, again, because this is an interactive web seminar, I'm going to ask you to look at this chart, and who can tell me where I would start my cycle finder line? At what point would you do this? At what point? Let's see. All right, I'm waiting. There's a little bit of a delay before the answers come through. Okay, Jan says September 23rd. Jan, that would be a good one. We can use that. In fact, Jan, that will be one that I will be referring to. But there's another one further left on the chart. Okay, Dana says August. Dylan says August 5th. Denise says August 5th. Eric also says August. Lloyd says August 3rd. All right, the majority of you, in fact, actually all of you, with the exception of Jan, and Jan, you're not wrong. You just picked another point. All of you are correct. So here's what I'm going to do. I'm going to start on August back here, and I'm going to connect that. Oh, what happened there? So, I got to click on the cycle line. There it is. So I click on the cycle line. I start there, and then I'm going to bring it to Jan's high. See, Jan had the 23rd, right around the 23rd, as the high. So I'm going to leave it right there. Boom. I'm going to drop it. Now, interesting, isn't this? This cycle finder has found a pivot point on all 4 points. And here's what I'm going to point out to you. Here, we started on the high, so obviously that's going to be the first pivot point. I went to Jan Silverman's high, dropped it there, so there's a pivot point. But look at this. This was a pivot point where the stock went up from this point, and then the very next one was one where the stock went down. So, I'm going to ask you a question regarding this pivot point. Okay? I'm going to ask you a question right there. If you bought the stock and you know that it's got pivot points every, let's see, so that was August 2nd, and this is roughly September. Remember, this is a daily chart. So this is roughly August. So this is a 6-week cycle that we found. 6 weeks from the beginning of August to the middle of September. All right, there's a 6-week interval between cycles. So we know that if we're thinking about the next cycle showing up, or let's say you bought down here and you're anticipating the market to go down here because you have your cycle finder there, what would be your defense strategy if you think the market is going to drop from this point? Let's say on this date you believe, because the cycle is every 6 weeks, you believe the market is going to drop. What would you do if you owned the stock and you're anticipating a drop in the stock? What would you do? Okay, Brian, I see your answer. I'm not going to yell it out yet. Louise, I got your answer. Okay. Anyone else want to even take a guess? Jen says sell calls. Okay. Eric says, all right. So, okay, here we go. Let me read some of the answers because we've got a varying a difference in answers, but actually all of you are right. All of you are right. Let's start with Brian. Brian says put a trailing stop. Now, Brian, if you could, try to give me a price at which you would have put your stop. Now, if you're a regular follower here, then you'll know an answer more. I would say you have a better understanding of where that might be than someone who's brand new. But I'm going to work with Brian for a second. We have a good group here, but yet still a small group where I could work with each and every one of you. Okay, Brian, put an answer as to where you would put a stop. You say trailing stop, but where would you put your stop? Brian says 173-ish, which is going to be right. Here's the scale: 172, 174, 173. So Brian would have put his stop right there. Now, Brian, I probably would have went a little bit lower, and I'll tell you why in a minute. But let's just go with what you told me. If you would have put a stop at 173-ish, your stop never would have been triggered, and you would have been okay for the next big up move here. Okay, so knowing that there's a cycle every 6 weeks, whether the stock goes up or down, you know that 6 weeks from this point and getting closer each and every day to this mark, you know you have to do something. And if it doesn't go down, and you still put a protective stop in there, you're still okay. The market went up. You didn't get stopped out. Okay, hopefully you got that. Now, let's go back and let's take Louise for a second. Now, Louise, this is what I'm getting at. And Louise, I think Louise understands this very well, otherwise she wouldn't have answered this way. Louise says, I would put a stop order just below the previous pivot point. Interesting, right? Let's see if I could do this. I haven't done this yet on this one. Horizontal. Okay, here's my horizontal line tool. Here's the mark that we're talking about. Here's the previous pivot point that Louise is talking about. See? That horizontal line, folks, that is a role reversal support line, because back here it used to be resistance. Resistance was broken here. It now holds a support here, and right on this cycle you think it could go down. So again, going back to your point, Brian, I would have moved my stop down probably $1.50 lower than where you had it, and that wouldn't have been too terrible because this is, if this was a stock you're trading, that $1.50 on $182 stock is not going to be a big difference. But the safer place to put the stop would probably be 171 to 171.5, right below that line. Okay, so that's Louise's answer, and Louise, that's probably what I would do. Brian, I would do the same thing, but I probably would have put it in Louise's stop loss area. Okay, let's go down. I'm going to try to answer all of you or address each and every one of you and how you responded. Jan says sell calls. Now, for those of you who are not option folks, understand that selling a call is nothing more than making an agreement to sell your stock. You don't sell your stock right then and there, but someone pays you to sell your stock at a certain point in the future. So Jan, here is what I'm going to ask you. You say sell calls, but if you could be more specific, seeing the chart the way it is and not really knowing what the future would have had in store, I'm just trying to get everyone to imagine that this is the day we're looking at. We don't really have data after November 7th. We're trying to imagine this didn't exist yet. You're at this point in time, and I'm asking Jan, okay, Jan, you think it could go down, but what strike price would you have sold your calls? Now let's see what Jan says. 172. You would have sold the 172 calls? Okay. Well, you would have gotten paid money, and you would have probably made money, but you would have capped your profit, because if you would have promised to sell your stock at 172, the stock is now trading 183. You would have lost out on all the other profit. So it's not a bad thing. You still would have made money, but you could have. Oh, okay. Jan's now correcting me. I was wrong. No, 175 or 180. Okay. So you would have put, let's say 180. Okay. So you would have been okay. You still would have lost your stock, but you would have been making $10 more than what you normally would have done if you sold the call lower. Okay. All right. Let me keep going back in the line here. Okay. So Eric says he would have put a stop around 171. So that would have been right, Eric, because that's where I would have put it. It's 171 to 171.5. Here's an interesting one. Michael says he would have bought puts on the stock. Interesting, Michael. I like that. Now, again, for those of you who are not market familiar with options, buying a put is where you take some of your money and you buy insurance on the stock in the event it goes down. Now, again, Michael, I'm going to drill you here a little bit and question you. You say you would have bought puts, which means you would have spent a little bit of your money to protect the downside. I like that. That's good. That's a guarantee it's a guaranteed insurance plan that you'd be buying. But my question to you is, what strike price would you have bought? Delta of 50. So you would have bought an at-the-money put. So you would have bought maybe the 170, maybe the 175 puts. Okay. Well, if the stock continued to go up, you would have just lost money on the put, but you would have continued to make money on your stock. So you would have still had a home run by buying the put as well. Okay, so this is really good. Lloyd also said he would buy puts. That's good, Lloyd. There's nothing wrong with that. If you had bought puts, both of you would have made money. Anyone who would have put a stop below 171 or below support, you would have continued to make money, absolutely. The only one who would have actually not lost money but not maxed out on their profit would have been Jan, because Jan, you would have sold calls above the market. Now, I have to try to keep this a little bit more basic in the conversation, only because I know there's still a lot of people who are new to even chart analysis, so I don't go too far over in the jargon. But let's go right into it. I still believe that if we look at the if I go to a daily chart, and I'm going to put in the Russell 2000, which is a more broad-based index, put in RUT. I want you to see that the the chart here, again, still in an upward trend, but we are still at resistance points. Again, I have to go to annotate to draw my lines on here. That's just one more step that I have to take, but it's not really a big deal. We still have resistance at the top here, so you have to be really, really careful with this market, because we're still in the first quarter, and we're going through what's called the January effect. The January effect rally is when people start buying small caps, especially institutions. So when that shakes itself out, you'll see money start to stabilize. You'll start to see the market maybe even settle down in volatility, and things will start to change. And actually the technical signals start to get clearer when there's less noise in the market. So we've looked at the markets. Basically, the charts are still telling us be defensive. I would like to, actually looking at the time clock already, I can't believe it's 25 minutes into the session. I would like to get right into your stocks. I mean, I think last time we had a really good session. We had some great stock candidates that came from the audience, actually. So when we go through the stocks, especially those who are joining us first time, get your pens ready, or at least some kind of a spreadsheet or a Word document, and get ready to write down stock symbols. Because our audience, you have to think, I have two eyes, I'm scanning the market. But if we have 100 people, that's 200 people, 200 eyes more on the market than just me. So we have our membership, especially our Oracle subscribers, they're scanning the market. And as a community of traders and investors, we together as a group, when we do this once a month, this is like almost like an investor club. We're coming up with ideas because everyone's scanning the market, and it works really, really nice. That's one of the greatest benefits of this monthly call is that we find good stocks. Okay, so Ron says, what would be a good entry point for Star Gas, which is SGU? So what I'm going to do, and I know we have some Canadian folks on the line. If I don't know if Stock Charts gives Canadian symbols, but I'm going to put SGU in the ticker and see what comes up there. Okay, so again, Ron says, what would be a good entry point for Star Gas? Let's go through, and I'm going to click on annotate so I could draw lines on here for you. Let's go through the charts. I'm looking at a daily chart to start. Ron, I'll go to a weekly chart here in a moment, but let's start with the daily chart. One of the things that I try to look for immediately is a pattern. I want to try to find what kind of patterns are we seeing. And the first thing that I see in Star Gas here is that the stock is actually in a trading range. It's in a trading range that starts here at this roll reversal point. Can everyone see that? This high back here on August 13th was a major resistance that was the result of a pretty significant bearish engulfing pattern here that day. Market opened up and then traded straight down after that. But that stock stopped right around the $5.25 mark. And then right here on October 17th, it broke through resistance. And then from there on out, and even until now, the stock is holding a 525 support level. So when we're looking at a chart, please do your best to try to identify the roll reversal lines first. I would say do that even before you start checking the moving averages, because as you'll see, the moving averages come into play. But when you have a trading channel, the moving averages mean very, very little when the stock is in the trading channel and stuck in the middle. All right, so there's the roll reversal line, roll reversal support. Then, if you look, you can see that there's a resistance high up here that peaked out on November, right around the middle of November, November 12th. and the stock came down, hit support, went back up, hit resistance, came back down, support, resist. See that? So Ron, when you're looking at a trading channel, there's only two places that you would even think about initiating a buy order. And I'm going to ask, again, I'm testing the audience this week pretty hard. I'm going to ask the audience, which are those 2 points at which you would buy the stock? There's only 2 points where you would buy the stock. Let's see. What kind of answers are we going to get here? Not coming up yet. All right, a little bit of a delay. There's 2 points where you would buy a stock that's in a trading channel. Okay, so now, Vlad, you're putting a price, and you're right on that, but instead of a price, I would be more specific. Try to give me a definition for the areas that we would buy, or okay, so Vlad, Rick is right there. All right. Okay, I see. Oh, okay. Keith gave me. I think Keith gave me the answer. Oh, close, Keith. All right, I'm scanning. I'm scanning. Okay, Kelly has it. All right, hold on. I'll give you the answers here. Vlad has it. Alan has it. Oh yeah, beautiful. Okay, here's the answer. Kelly said a bounce off of support or breakthrough resistance. That's exactly right. When the stock is in a trading channel, there's only 2 places you would buy it. A bounce. Remember, a bounce, that's the key, a pivot point bounce off of this support level. So if it goes from 540 to 535 to 530 to 525 and then goes back up to 530, there's your bounce. A bounce off of this line is the first place that you would buy it. The second place and only other place that you would buy this is a breakout over and through resistance. Absolutely, those are the only 2 points. When you have a stock that's in a trading channel, it's either bounce off the support within the channel or a buy on a breakout over the resistance and through the channel. Those are the only 2 places. So let's give you the second part of this, because you're right. And believe me, remember, this was the beginning of a question. Remember, when Ron asked, what would be a good entry point, you have passed the test, and you're helping Ron understand where those entry points would be. And again, remember, if I just told you a bounce off the support or a breakout through resistance, you could look on the chart to see what those prices are. So all the other folks that gave me a price, that's probably what you were looking at. But I want to be more specific and not just give me a number, but what's the reasoning why we're buying at those prices? Okay. Now, here's the second part to this. Now, I know this doesn't go along with a rapid-fire stock analysis format, but we're going to proceed in analyzing stocks the same way every time with every other stock that I analyze with you, so that you can, again, recognize this very quickly on your own. Okay, so here's 2 questions. Number 1, if I do buy the stock and it's bounced at 530, because I see it bounced off of a key support level right around 25. So imagine, I'm buying the stock at 530. Where would I put my stop? And again, that would be a more specific number. And if you want to elaborate on that as to why you picked that number, go right ahead. Let's see. Looking here. Okay, Shannon, you're right. Stephen, you're right. Keith, you're right. Okay, you give me prices. Oh, there we go. This is what I'm looking for. Louise, beautiful. Tell you, great. You're like one of those students that sits at the front of the class and polishes. The apple is the good teacher student. You're doing great, absolutely great. Louise says 520 just below support. Exactly. If you buy it at 530, 535, you want to put your stop below the blue line or below support. And Louise specifically picked 520. Now, Vlad said 5, Keith said 515, Stephen said 510, Shannon said 520. Yeah, all of those prices are correct because they are below the support level. Okay, now let's move on to the second entry point. let's say I buy the stock because it broke out over this high. Okay, so now it's breaking out over 560, trading 570, 580, and so forth. I bought the stock right above here, so I'm going to put a little line above. This top line is my purchase price. Now, where would I put my stop if I bought on the breakout? Let's see, and then again, if you want to be more specific. Okay, Vlad again. All right, I see that. Lloyd, okay. Michael, Robert, you're all right. Keith, Shannon, Denise, good. I don't see any wrong answers. Jan, 550. Okay. All right. Here's what the answers came out to be. All right. Vlad, 550. Lloyd, 560. Alan, 545. Michael, 550. Robert, 550. Keith, 552. Interesting. You're right. You're absolutely right. Now, but no one answered, except for Jan. Jan gave me a more specific answer why she selected 550. Jan put 550 because it was below the breakout point. And that's exactly what I was looking for, because remember, the blue line, the resistance line, was the breakout point. And if it breaks out over that line, remember, resistance turns to support. So I now use the breakout line as my gauge for support. So if I buy it at 565, 570, 580, I'm going to put my stop below the previous resistance, which is now current support. So that's good. Okay. And then Vlad said he would use the 1% rule to do that. That's perfect. Okay. Now, here's where you're going to have to be fast on your fingers, and I'm giving you fair warning to get ready to type in a symbol. Go. What's the next symbol? Who's going to give me the next symbol? Oh, wow. Dylan is fast. Woo! Dylan, you must have read my mind, because that came in before I even had the period at the end of my sentence. But let's go in. Looking at 3M, and let's see. Dylan is asking me, would you say a pivot point is formed on 3M to go long? I'm going to put this in. Put triple M in there. Hit enter. Hit annotate, because annotate allows me to draw on the charts. And let's look at 3M. Now, I don't know. I'm so used to looking at stock charts. I don't know, but that to me, Dylan, looks like it looks like a red candle. How about it? Does everyone see a red candle right there? Number one, if you're asking me to go long, I would absolutely not go long if I see the red candle. But I do see what you're talking about, Dylan, with regard to a pivot point. Here is a role reversal line right here. Okay, there's the role reversal line. So former resistance was broken here on December 18th. It bounced here on the pivot point, which, by the way, Dylan, last week it bounced. And a couple of things point out to me. Now, again, I don't always want to be the educator that talks all the time. I love this interactivity, because it gets you thinking ahead in my questions. It's really what the market is going to ask you. If you think to yourself, okay, I'm by myself, I'm by my computer, here I am, Dylan, I'm looking at my computer, I see a pivot point, it's bouncing off a role reversal line, what are some of the other things that I need to have on my checklist? Well, let me help you with that, and these points are going to help you without a doubt with regard to what to look for. When you're looking at a pivot point, you have to look, okay, where is support? We see that. What color is the candle? We see that. What is the volume doing? Now, it's harder to see because it's in shadows here. See the volume bars down here? They're in shadows. What's the volume doing? And another thing you have to look for is, are there any gaps on the chart? Reason we are looking for the gaps is because gaps, act as magnets, and you have to be very mindful of that. So again, helping Dylan, let's go through that checklist. Is it bouncing off of the key support level? Yeah, role reversal it is. What color is the candle? It's red, so we're on hold right now. Right, so we're not going to buy. Now tomorrow, if you see a green candle, go for it. But try to make sure that the green candle is at the end of the day, within the last 15 minutes, because tomorrow morning it might open with a green candle, and by tomorrow's close, it could be, excuse me, it could be completely eliminated by the close. And remember that I'm talking as though this is today's trading. This is from Friday because the market is closed today. But this is Friday, and it's a red candle. So if on opening tomorrow it's green, you still have to wait with patience to the end of the day. So if it's green, go ahead. But because there's a gap below the market right there, because there's a gap, you have to make sure you're putting your stop below support, because the gap is going to continue to act like a magnet. That's the space right here on what day is that? That's December 17th. The stock gapped up, so there's still a gap that would be filled only when the stock gets back down to the 128 level, 129 level, right there. So that blue line represents where the gap fill point would be, and so you got to be careful of that. So if you're buying it at 137, I would put my stop probably around 133, and then leave it. Just don't get back in until it bounces off of the gap support. Then I would give it maybe a second try. Okay. Now, trying to go down. Brian, MNKD, he doesn't have a position yet, but he's waiting to buy on the next green candle. Let's look at MNKD. And going back to my stock charts format. Again, I don't think this is too bad for charting. Hopefully, you can still see this clearly. I'm okay with this one so far. We roll with the punches on the technical issues, no problem. Okay. And on that note, how many of you have been on a trading platform and then all of a sudden you lost internet connection, or you lost connection to that broker? Has that ever happened to you before? Well, if it hasn't happened to you before, it's happened to me many times before. If that ever happens to you, or has not happened to you, I should say, you have to prepare for that. That could very well happen. Imagine you have a position and now you can't get through to your broker. What are you going to do? You're at risk here. So I would encourage you to get some kind of a direct line to a person and not a computer voice. Call the broker and say, listen, do you have a backup line in the event my computer goes down or I lose connection? Can you help me? Get that rate, put that baby on speed dial, okay, because it could happen. And another thing I do is I tell people, get a secondary broker, even just as a backup, because even if you just put a little money in there, because here's what you could do. Let's say, and I'm looking at MNKD here, trying to help Brian here. Brian does not have a position yet. Let's click on annotate, and I'll show you, and then I'll talk to you about how to back it up in the event you can't get through to your broker. Okay. All right, let's go. Who can tell me where to draw my role reversal line? I almost did it without asking you this question, but who can tell me where I should draw the role reversal line? Okay, Robert's also looking at, is it MNKD? Or, let me see. What did I put in there? Is that not MNKD? Yeah, it's MNKD. Okay, Mankind Core. Okay, who wants to put a guess at where the role reversal line should be drawn? Okay, I see that, Lisa. Thank you. Michael. Oh, very good. Okay. Wow. You folks must have read my book. Wow. All right. There we go. All right. I have. I'm not gonna name names because there's so many. 550, 553, 560, 530, 550, 550. Yeah, let's go with that. It's right around here. These highs, right here. I would say right here is where I would do it. Right around 550. Now, I could actually go back and extend this line to the left. See what happens when I do that? Because this is a key role reversal line that has at one point acted as support and did the role reversal the other way. Does that make sense? Look, here was support. The stock broke down below support, and then it held as resistance. We call that breaking down below the ice. The analogy there is you're walking on thin ice, fall through the hole. The blue line represents the layer of ice. You fall through the hole in the ice, and now you're bumping your head against the top of the ice. You got to get out or else you're going to drown. So that's what happened there. But it held as resistance until it broke out over resistance on January 7th. See, now it's reversing its role back to the way it was back in August. It broke the resistance. Now resistance turns to support. So 550 is the role reversal point. Okay. So again, going back to the question of what should we do here? I would wait for the green candle on this one, and I would feel really good about buying this one for a couple of reasons actually. This stock is trading very technically over and above the role reversal, but look what happened here. Can anyone see this? This was a downside crossover, but the 50-day moving average is now starting to go up. See this? It's starting to curve up. And we're only a matter of days away. If this stock starts to rally up, this 50-day moving average is going to cross back over the 200-day moving average, and that is that's going to be a significant event, because if the 50-day moving average goes over the 200-day moving average, you're going to have a lot of institutional investors starting to get in, which will only add to the higher levels of the stock. Okay, so that's what I would do. I would wait for the green candle. Support is at 550, so we know what to do after we buy the stock. We put our stop below 550, and then we're going to wait with the stop loss order in place. So I just want to do something. I want to look at the weekly chart on this one to see if we see any difference. So all I did is I go back, changed it to weekly, then click update, and there we go. See, now a little bit different thing happened that's significant. This is a weekly chart, and the blue line on the other chart represented the 50-day moving average, but on this one now it's a 50-week moving average. And the 50-week moving average already crossed over the 200-week moving average. And this, to me, looks like it might even be the beginning stages of a cup and handle here. This is the cup right now, so we have to watch that one. I like this one. If I was one of you watching this for the first time, I would actually write this stock down on a watch list, and I would keep it, because this one is cheap enough where we can trade it. Excuse me. And there's enough shares being traded to give it the liquidity that we need. And if you're trading cheap stocks, understand that most institutions are not going to be trading the dollar stocks. Over $5, yeah, you're going to find more institutional activity. Under $5 is a higher margin requirement, so a lot of the money managers are not going to touch those. So be really careful of that, because if you're trying to trade stocks just because they're really, really cheap, you could be risking a lot of your money because there's no institutional support there. So MNKD looks like one of those good ones. By the way, I've just added this one to my watch list. I am multitasking with you here, and I'm putting that on my watch list so that we can keep an eye on this, and maybe I'll make some comments in one of the future oracles. Okay, so who wants to offer another stock? The scroll has taken place, and everything that you put in before has already gone by me. So let's see. Stephen says, considering to buy GERN. Stephen, I'm going to go back to a daily chart, and I'll start there, and then we could, if we have to, go to a weekly chart. GERN, and interestingly enough, let me zoom in here. This to me looks like there's a bullish engulfing pattern that formed on Friday. That's very interesting. So let's go through the exercise here again. And if anyone can please tell me, this is going to be a little bit trickier actually, because the stock is now below the 50-day moving average. Where would I draw my horizontal line to initiate a role reversal line? Let's look at that chart again. I'm not going to give you any hints here. At what price? Doesn't matter really. It doesn't. Now remember, as you're answering this, understand it doesn't mean you have to get it right under where the stock is. It could be from August. I don't care. Where would you put a role reversal line? All right, Jan didn't give me a price, but I like what you're saying, Jan, and I'll explain that in a second. Okay, Michael says, all right, Michael's very close with Jan had, and I wouldn't argue with that one. That one's a good one too. All right, Eric, all right, I see yours. Nate, I see yours. EC, I see yours. Oh, by the way, EC, that's a $4 stock, not a $40 stock. EC's put $4 or 40. Keith Doyle said 375. All right, here's what I'm going to do. I'm going to draw the line where I would put it, and then you'll see how close you are to that line. I would have gone with this one here. I would have gone with that line right there, because here is again a noticeable resistance line at 20 and on the 27th of September. This, without a doubt, was a breakout, because you can see the volume supported by this breakout move and that big candle. And then as soon as the breakout occurred, the stock drifted back to the role reversal line, the new support, and then bounced with a gap. Isn't that interesting how it bounced with a gap? So that is just one role reversal line. That's one. So anyone who put an entry point above that line would be right where you got in. Okay, now I'm going to draw a secondary. Paul said the chart did not switch. Does everyone see GERN on the screen now, or did Paul's screen maybe freeze up? If you could answer me, that would be good. Oh, it did switch. Okay, all right, Paul, you got it now. All right. Now let me do this, because when we're buying a stock, remember, we want to identify the support so we know where to put our stop loss order. And if we're buying a stock, and let's say we buy the stock at 451 because we see the bullish engulfing candle, we see support around 350, so we put a stop at 340. The difference between 340 and 450 is going to be about 60 cents, right? 340. I'm sorry. Yeah, 340. That's $1.10. Excuse me. So if we put our stop at 340 and we're buying it at 451, that's roughly it's roughly $1 difference between our buy price and our stop price. So our risk per share is going to be $1. Now, I'm not going to spend any time on this call going over the 1% rule, because that is already being repeated over and over on the web videos that we have. So if you're new and you want to learn about what I'm talking about, go to the Market Guys website and then click on the video tab and you'll see the 1% rule. If I have a $1 risk per share, that means if I buy the stock and I get stopped out, I lose $1 per share. And I can figure out how many shares I buy based on that number. Now, watch. I'm going to draw another role reversal line right here. See that one? Resistance, came down a little bit, popped out, broke out, pulled back to support. Here's another support level at 264. Now that's $1.90, roughly $1.90 difference between my buy price and my stop price. In fact, 264 is support, so I would probably put my stop somewhere below that. It might even be at 251. So now I'm risking $2 per share. So the distance at which I would let this stock drop is more than twice the previous stop level. And that's okay. I could actually put a stop down there and be okay. But what has to change? Here's the question. I'll clear this up for you if you've lost me. In scenario number one, I'm buying the stock where it closed, and I'm putting a stop $1 below my purchase price because I'm using this first level of support. In example number two, I'm buying the stock where it is right now because of the bullish engulfing pattern, but I'm putting my stop at a lower level because I'm using this support. So choice one is I use a $1 stop. Choice two is I use a $2 per share stop. If I'm using the 1% rule, what do I have to adjust in order to not lose any more money if I let the stock go down further? What do I have to adjust? Okay. EC came, all right, beautiful. Jan says buy less shares. Absolutely. EC says the amount of shares you buy has to change. Position size, Michael says. Yeah, absolutely, it has to be smaller. Okay, you're getting this. Now, here's what I'm going to ask. All of you who answered correctly are not going to answer my second question. How many of you, and all you have to do now is raise your hand. There's a link there. You could raise your hand. How many of you still are unfamiliar with how to use the 1% rule, engaging the size of your position? How many of you are still unfamiliar? If you can't figure out how to raise your hand, just go into Q&A box and say, I'm still confused, or I still don't know. All right, there's more people that came on after I started than I thought. There's a lot more people on the call now, so there still might be. Okay, here's what I'm going to do. Of course, it's very difficult for me to do this, but most of the people on this call are Oracle subscribers. If you are an Oracle subscriber and I put out a trade and I'm specific as to where I'm telling you to put the stop, and you do not know how to use the 1% rule, I'm asking you, please try to get in touch with me. Now, the mentors that we do are, the people that are able to have free access. But in this case, I'm in 2014. I want people to make money. That's my goal. My goal is for people to make more money this year than they did last year. And we had a pretty good year with the Oracles last year. We had a good rate of return, and we also had a very accurate percentage of accuracy, very strong percentage of accuracy. My goal this year is to help you make more money. And the only way you're going to make more money in 2014 is if you become a better manager of the risk in your position. That's the only way. Because you got to remember, I'm talking about a market correction this year. The people who are going to make the most money in 2014, I believe, are not going to be the ones who pick the best stocks. The people who make the most money in 2014 are going to be the people who are better at managing risk and setting stops. And taking it one more step further, the people who learn how to short stocks and make money on the way down. Those are the people that are going to make more money. Absolutely. Now, Ron asked me a question, which is better moving average to use, a 20-day or a 50-day for trading purposes? Well, Ron, for a trader, you want to use the shorter moving average because that's going to be more sensitive. It'll trade more closely to the actual price of the stock. And to help you with that, if you're in complete doubt and you don't even know technical analysis, but you just know one thing, remember this. If your stock, if you don't know what to do and all of a sudden your stock is above the moving average and now it starts dropping and closing below a 20-day moving average, the best thing to do when it starts closing below the 20-period moving average is to get out until it gets back up over the moving average. So if your stock starts closing below the 20, get out and stay out until it starts showing more positive price action. All right, so hopefully that helped you out. All right, so we're already at the top of the hour. Here's one last bit of housekeeping here. Bill Shanley, my partner, is on the line. He's recording this right now. The recording goes to the members of the Oracle who we have on our books, and we have email addresses for. What I'd like to do is ask you to simply find somebody that would benefit from this information. Invite them. I don't know what your 2014 resolutions are, but how about I challenge you to a resolution? How about you start a community effort to help people with investing? You don't have to be a financial expert. Some of the ideas I'm giving people is, and this is one of the reasons I'm putting this one out, is because my son is in high school. High school kids are not being taught this information. So if you know any teachers who would like to start a club with the schools, I'm actually an adjunct high school instructor for technical analysis at one of the local high schools here, and it's called University High School, and they have an accelerated program for kids in the financial industry. And what the teacher does is allows me to do what I'm doing with you now. I do web seminars for the students, and then the teachers build curriculums around that. They work it into their economics plan, 101, supply and demand. They teach kids basic stocks. Try to reach out, especially to the teachers out there. If you are part of a retirement community, how about this one? Go to the president of that association or club and see if they want to do something similar to what we're doing now as well, or even invite them to the monthly open house Q&A. Why am I interested in talking to those people? Because most of those people have their money parked somewhere with a broker who knows very little about managing risk. They'll put them in mutual funds all day long, talk bonds all day long, but when the market comes and starts to correct, these people are not going to get the phone call from the broker telling people to liquidate. Because those brokers, I'm not going to mention names, but those other brokers get paid on how much assets they have in the account and how many times they can put you in a commission fund somehow. That's how they get paid. They're not going to tell you to get out. So I'm trying to get the word out to people. So I'm going a little bit over on my presentation here, but I think it's for good reason. If you are a family member who has kids, grandkids, nieces, nieces, nephews, if you're of the younger generation, you have aunts and uncles, make a fun thing about this. Facebook has the ability to send out an invitation for an event. Create your own event. Invite people. This is interactive. I will help you. And I'm going to tell you something. They will thank you for inviting them to such an event. I'm reaching out because no one is even thinking this way. You're not going to have Charles Schwab calling you and say, listen, call the high school. Not going to do that. We're trying very hard to get the market guy philosophy out of showing people how to make money by following the money. And finally, if you wound up on this call and you're not a subscriber to our alert services, just look at it. At least look at it. It's inexpensive, and one trade can wind up paying for your whole year. If you do the trade correctly, it can wind up paying for the whole year of Oracles, and then you get all free after that. So we have promotions from time to time. Bill puts those out, and we're really having a great time. We enjoy talking about the market. I like talking about some of the folks like Andrea, who's on the call right now. I mentioned her last time. She's probably going to turn red in the face in embarrassment, but Andrea, one of our members, loved the idea of learning technical analysis so much that she joined the Market Technicians Association. And Andrea, correct me if I'm wrong, but I think you're the only woman in that group teaching them some new things. It was kind of funny because Andrea and I were laughing about how some of the techies, the technical people, come to these clubs and they're so sophisticated with their formulas and programs, and then Andrea comes in there and talks like, okay, guys, did you happen to look at the volume? Because they have so much stuff on the chart they can't see price action anymore. So, but that's what's happening. People are getting inspired, and they're learning, and they're enjoying it, and they're sharing it. And as a result, people around them are thanking them and benefiting from it. So, went 3 minutes over. I hope you're okay with that. Have a great evening. I really look forward to our next talk. Stay tuned to the next alert that's coming out, and we'll talk to you then. Have a good one. Good night.